Welcome to the Crownsmen Show. I'm your host, Jerrod Downey. I've got two other hosts, the amazing Rory Bamford, the old Roy Slack. Gentlemen, welcome to the show.
Yeah,
welcome, Roy. Welcome, Jerrod.
That was a warm welcome.
Yeah, I'm excited today. I'm feeling good, feeling positive. How's everybody doing? Rory, how are you doing? I don't know why
I think that was to me, so I'm going to say I am great. I lost a battle. Over the weekend, and that was not good. But the bread knife won, and I'm ashamed of myself for that. But everything's healing properly. Didn't lose an entire hand or finger, so that was a positive.
Are we talking about cutting your finger with a bread knife? Is that
maybe?
Okay, all right. We got bread knife cut from Rory. Roy, what's been going on with you?
Well, I didn't cut myself.
With a bread knife.
You know, I may be old, but I'm not that depressed. Yeah, what's going on with me? I was up to the cottage. So we have no snow here where I am. We got 4 feet up at the cottage. So I was up at the cottage on the weekend and I had to dig my way in. And I dug for an hour and a half, but I took a 15-minute break in between so my heart wouldn't explode. But made it in there. But yeah, lots of snow in that area.
That's yeah.
Are we talking weather now?
Yeah, I feel like I don't know where to go from there.
Already?
It doesn't get better than that.
Hey, Jerrod, how's the weather in your neighborhood? How are the dogs getting
good.
through the
good? I'm actually
the rain?
Yeah, I weighed myself yesterday, so I'm on a new diet as of this morning.
Water?
Not good, but so my new dieting tip for everybody is what I do, and this is I was in a rush and I did this kind of without thinking. I wanted to buy a donut, so it didn't cross my mind to not buy the donut, but I took my coffee black to save sugar.
And next time when you get the Whopper combo, just make sure you get a Diet Coke with it.
I've been given up on the combo. I used to do a Whopper with a chocolate milkshake. Cut that out. Now I spread that out over 2 days. Gentlemen, we got lots to cover today. Rory, what are you focused on? I know you. Oh no, sorry, cranky old men drinking beer, right there. Rory, what are we drinking today? What are we cracking open? That's a big part of the show, is that we actually drink. By the way, it's 10 o'clock in the morning here.
I love this name.
It is 5 o'clock somewhere. This is called Naughty Neighbor. It's a pale ale by Nickel Brook. And I found this interesting. I don't know if you guys saw the progression of the beer can art, because originally when Naughty Neighbor came out, there was kind of a cartoon picture of a girl like a pinup. So Naughty Neighbor was like sexual innuendo. And then the next version of it, somebody had clued in, well, maybe they're talking about the States, and they have this now. Right, so Naughty Neighbor. This isn't a reference to your next door neighbor, an affair or anything like that. This is a reference to, obviously, the USA with
pretty good,
with a cranky old eagle on the front. But now the next version, they've just put it out to their to their clientele to vote on the next label, and the next label has like kind of a devil or a devil couple at the house next door and everything on fire. So we talk about pivoting, Jerrod. They're pivoting away from this reference to the U.S. now to a more goth or sinister or whatever neighbors. So
that reminds me of the horror film, but I don't even know why. Like the middle one, I'm forgetting the series now.
Carrie,
maybe.
Yeah.
Oh, I see. I didn't see these in the notes here. Okay, we got to bring these up for everybody to see. So this is kind of neat. So they do a progression. It's the same beer, but they just rebrand the can and kind of get everybody in on it. That's a good idea. I ruined my pour. So,
that's outstanding. 10 out of 10 on that one.
So we're gonna. Wow. Yeah, let's rate the pour.
Cheers, gentlemen.
Cheers.
Let's see how this is for breakfast.
Oh boy, Gowdy, how are you? How's life? How are you feeling these days?
Depressed.
Cool. Well, thank you. We got weather, depressed, and butter knife cut.
Butter knife. Okay, that's a little extreme.
It's not easy to cut that's not easy to cut yourself with a butter knife.
No.
It is not
So,
easy.
Like
Rory had to work at it to, well done, Rory.
Maybe he
Not
is
everyone
also
can do that.
impressed.
Applause.
Okay.
Let's talk about our heavy industry world tour brought to you by Savanaugh Equipment. Find, market, and sell surplus and used equipment. We are heading to events across North America and Australia and filming episodes on location. Email us at info@crownsmen.com to be part of Crownsmen's Heavy Industry World Tour. Did you know cementitious binders can be responsible for up to 70% of the total GHG footprint of mine backfilling processes? Now you can replace up to 50% of the binder in your mine backfill operations with Graybond, Graymond's new low-carbon cementitious binder. This lime-based alternative binder maintains a 40 to 70% lower GHG footprint compared to typical cement and can adapt to varying mine conditions without compromising performance. Learn more about Graybond at graybond.com. Join us in the depths of the mining world, where global leaders and industry giants converge to shape the future of mining. From groundbreaking technologies, advanced machinery, revolutionary safety measures, to sustainable initiatives. This is the voice of mining. This is Mining Now. Showcase your company to millions worldwide. Book your episode now. Visit crownsmen.com.
Rory, what are you focusing on today? We had some topics from last week we wanted to cover, so let's jump into it.
Yeah, we wanted to jump into the evaluation of businesses. And so I've been kind of like looking into this basically all week, which is interesting. Now, I printed this so I don't have to clack around on the keyboard today. So sorry, everybody. But I guess one thing that's to start out, if I'm looking at a company, and this can be in heavy industry, this can be, for investing, I go across like the whole spectrum, but we are a heavy industry focused show, so we'll use that as an example. So the first thing would be, does it have a high barrier to entry and a large moat? So if I'm looking at oil and gas as an example for that, you go, well, that's a commodity. You can't have that. And I would argue or say you can, because if you look at an ExxonMobil or a Suncor here in Canada, what do they have for, like, what do they own for reserves? How many barrels do they estimate they have? You can't be another company and just go pull those reserves. Those are huge assets that they have, that they've built up over time. So that's one main area that I personally look at, because that's a good starting point. And then from there, it's going into, the number one thing is profits, and are they increasing? So that's like the very first thing that I'm going to, again, going to the bottom of the balance, or not the balance sheet for that, but for the income statement, going to the bottom and seeing, okay, what has this company been doing for profit? And then of course correlating that with revenue. So, but I'm just curious, any insights on that, Roy and Jerrod, before we get into more of the evaluation?
Yeah, and maybe it's specific to natural resource companies, but we always look at a couple different things. One, is it a single asset company? And is it diversified in terms of, in mining, for example, is it a copper company, or is it copper, nickel? Is it diversified a bit so it can ride out some changes in commodity prices? What countries is it operating in? This geographical risk. There's Mexico just changed some of their mining laws. Argentina has been up and down. And even Canada at times has looked at different tax regimes on natural resources. So
I like that's a really good point, Roy, because I've had some fun experiences as I tour around the world to invest. So there's shares that are called ADRs, which are listed in the USA, and we all know a few years ago the Russian-Ukraine war started, and I may have been invested in one in a Russian company, and you quickly realize the geopolitical risk that is at stake for companies that are outside of like well-known jurisdictions like Canada or the USA. So it's a very good point, and it is something that people should be aware of if they're investing. Buffett always says, buy a company that you love, and especially if you think like, doesn't matter if they don't trade for a few years. Well, I'm putting that to the test. So
Jerrod, did you see the rest of the notes? I had a Warren Buffett quote in there for Rory's benefit, because he's a Buffett boy fan. But
wow.
And this actually wasn't a quote. This was in an interview, and the interviewer asked, he said, Warren, you've mentored a lot of people. Where do you look for advice? And Buffett said, the mirror.
I'd like to know, we all consider you to be the financial business experts, and we look to you and follow your lead. But when you need advice and feedback about an idea or decision, I'd like to know, who do you go to?
Well, usually I look in the mirror. I mean, to be perfectly honest.
And this was a part of an interview, and whether it's egotistical or whether but it was very quick. There was no hesitation.
Or accurate.
When you are the guru, I don't know if I pronounce guru right, or is that a character from Minions? But if you're the guy, who do you bounce ideas off of?
It's funny. I forget his name, or I just sent you a video of him yesterday, though. I saw he was
so
talking
good
about Mark Cuban, and Mark Cuban goes in. He asks, basically, I'll paraphrase. We can actually put a link in the description for that video. It's a really good one.
Yeah, we should. It's really good.
But when he goes into a meeting, he assumes he's going to win. That's Mark Cuban just thinks I'm going to win.
It was Mark Herjavec, who was one of the founders of Shark Tank Dragons then.
Effortless Corporate Traveler Management is here with Corporate Traveler Canada. Boost your business with trusted expert solutions that save time, money, and enhance the traveler experience. Trusted by thousands of companies worldwide. Book and track your travels on your phone, or let your dedicated consultant handle it for you. Enjoy 24/7 support and live chat from any time zone, and get real-time travel alerts anywhere you go. Your next business trip just got easier. Learn more about Corporate Traveler Canada at corporatetraveler.ca. Attention builders, we've got everything you need to know about the grit and grind of the construction world in one show. The Construction Show is where you can share your expert techniques and strategies to help keep the crew strong and construction sites secure. From foundational tips, industry trends, safety strategies to advanced equipment and machinery. Be part of the voice of construction. Book your episode and showcase your company to millions worldwide. Visit crownsmen.com.
So that quote of Buffett it's a funny quote, but it's like I actually get it because he really has proven that.
And just going back to the evaluation, so that's a starting point, obviously. And I wanted to get into because this is where it gets a little bit more fun, and it gets a little more on the. They say intrinsic value, and each person that looks at a company is going to come up with a different number, even when Charlie Munger passed away, but even Charlie and Warren, they wouldn't get to the same number for every business because everybody's going to evaluate, just like Jerrod, Roy, or myself. We're all going to evaluate different things. So there's a couple other ones that I find pretty interesting. So the interest coverage. This one is pretty crucial because it will measure and gauge how a company can grow. A lot of times I'm looking at a company and I want to see interest coverage minimum 6 times. So the earnings should cover those payments by minimum of 6 to 1. Different industries are going to be different. So if it's a more volatile sector, I would want to see that higher. I would want a bigger margin of safety. I would want to be 8, 9, 10 times, because then I know if, God forbid, we have another pandemic or just a major conflict breaks out, things like that, you want a company that can ride that out. So that's really important. And it allows for growth as well. And it also, if if you get the winning company out of a sector that has really good management with cash, likely they're going to be the ones that, like the one that withstands massive blows as well. So I think that one's huge. I think it's kind of like looking at it in a way that you would look at your own personal finances. Like, what is your credit card debt? What is your lines of credit? What is your car payment, mortgage? All that, you kind of have to apply the same metrics to a business. So that one, any thoughts on that one from you?
Well, I have a question. What would be an example of a company what would be an example of a non-volatile sector where you go, okay, 6-1 is fine?
I would look at like Google, Apple, Amazon, companies like that. Amazon has they're notorious for like running almost like purposely. They run at losses, but that's because they can borrow enough debt. They're just so huge on the revenue side, which actually isn't. Jerrod, that's a good segue, that question, because I look at what is the price to sales as well. Roy, you mentioned that last week. So price to sales is a bit of a tricky one, but it definitely correlates with the debt level, because how are the sales rising, and like what is the multiple you're paying on those sales as well.
So Amazon is an interesting, because you're talking about like how we get to an evaluation differently, right?
Yeah.
If you look at like an Amazon, to do what they do, it takes like I'm here in New West. On one side of me on Burnaby, there's a center, an Amazon center. Then right behind me, a couple kilometers away, is another Amazon center.
Right.
The parking lot of the vans, like it's just and this is little Burnaby, New West, right? This is not even their big one.
Mm-hmm.
It's just a massive amount of vehicles. The vehicles are just dry, especially now with Great Canadian or Canada Post is keeping them busy right now.
They're back though. I think they're back.
Oh, I missed it.
Canada Post is back as of Tuesday.
Yep.
Oh,
yeah, we've been delivered.
Oh, I missed it. Okay, great. So
breaking news to Jerrod.
Breaking news to me, yeah.
He doesn't get any mail anyway, so.
Boy, you're only half a beer in. Half a beer.
That's a couple sips.
Apparently, he doesn't get any mail. He didn't know Canada Post was working again.
But I was going to say that is to do what Amazon does, not just for tax purposes, but just at the scale, they have to make huge capital investments.
Yeah, and they have to go get that capital.
But the other thing where I think you could make a big mistake is if you're like on the entrepreneur side. If we went into 3 different states and set up a studio and invested millions of dollars to do that, Amazon has all this infrastructure already. So when they move into, let's say they go from, now they add a place in Langley, they add a place in Kamloops, and on they go. They have such a proven model. That risk of investment and that debt that they take on to do that is a completely different thing than if they're not throwing Hail Marys, is what I'm saying.
So Jerrod, what is interesting, it also ties back to like that video by Robert Herjavec.
Close enough. He said like the untraveled road is basically paved with gold.
Yeah.
Amazon basically created that, like their own road.
Yeah.
Good luck trying to compete now. Good luck. If you try and duplicate that, well, immediately the bank is going to go, you want $1 billion, but you realize Amazon in every single major hub, they've got delivery vehicles and warehouses, like they're in every single location. So,
but here's something I'm not sure of. Do they? Like first of all, in the distribution, there aren't Amazon trucks coming up my driveway. They're kidnapper vans, eh? The white vans with no windows. Distribution centers, yes, Amazon has some, but are there not distributors in major cities where the building isn't owned by Amazon and they're just utilizing it? If I were Amazon, I certainly wouldn't be buying buildings all over.
Right.
That's a good point. That is a good point, because
I don't know.
I'm pulling it up. So Amazon had warehouses in almost every state and province in North America and Mexico. They have more than 110 active fulfillment centers in the U.S. and more than 185 globally. So you are correct, Roy. They probably, I can't imagine they own every single one of those buildings. They probably lease them out. So in that sense, if you were going to take a run at like kind of duplicating maybe a model, you'd probably want to look at a place that's maybe been overlooked or doesn't have as much service.
Right, but the problem you'd run into right away is you would have to get users. Let's say you go to a smaller town like let's say Kamloops, 80,000 people or 90,000 or so, whatever it is. Yes, Amazon may have not invested in a distribution center for there. They might be doing a partner distribution with their shipping and all that sort of stuff.
Yeah.
But still, to go in and compete with them, you would have to get, Rory, you're in Kamloops. Amazon would have to, the competitor would have to deliver something so much better that you would switch from Amazon to their platform.
So there's something out here, this is a bit of a different take on it, but you're not going to compete with Amazon, but can you, so I'll give you an example, and this is a software that's out there. When you buy something from Amazon, are you buying locally?
No, not usually.
If you want to buy locally, there's a software, I think it's called Red Maple, and you just put it on your laptop, and when you order something from Amazon, or when you look at something from Amazon, Red Maple will tell you who sells that locally. So the software itself is piggybacking on it. I don't know how well the software is doing. I saw an angel investor presentation on it a few years ago, and I know it's out there now. But the point is, why take them on?
Yeah, that's
maybe you can be a distributor.
Yep.
Maybe you can fill a gap, like if you're buying Amazon and Jerrod is a tree hugging environmental activist. He may not like something that Amazon does, and there's a green site that doesn't do that. So you look for those gaps and apps for gaps.
Also, very good point.
What are you laughing at, Gowdy?
Sorry, I can't laugh. Rude.
We were all taking ourselves very seriously, and you're sitting here laughing at us.
I was laughing very seriously.
Seriously?
But I do find this an interesting thing because I do like, Rory, because when you're talking about that, I think there's almost this temptation to, you look at an Amazon, this is the conservative hat coming on, you look at an Amazon, what they do and go, if we do that, it's like when we used to follow like Jack Welch's leadership strategies, and you quickly learn like, but he's running a massive corporation. Yeah. You have to adapt. You better, what you're saying, Roy, like gaps for apps or apps for gaps that's actually a great way to think of it, because if you go and try to do what Amazon does, you can get burned very easily. If you try to see where they're lacking and fill that gap, then maybe there's an opportunity. And that's that road less traveled, Rory.
Exactly. And like Peter Thiel in his book 0 to 1 talked about it. I mean, that's probably, for running a company, that's probably like been the most influential book that I've actually read regarding entrepreneurship, because it's going back to that road less traveled, like what he was talking about in that video, because what you can see a really good product, but it's not doing this, so we need to fill that in. Like there's an opportunity there. And that's where it's interesting. If you look, another thing to look at with evaluation, because there's a bunch, but is okay, even if they have a moat or they've got like a really good they have really good cash flow, what are the risks to that? Like what's going to come in and cause potentially issues? Jerrod, we're using this new software. The first thing that I'm looking at, and they identify as well, and I won't mention the name just at this point, but is the privacy. You see all these issues happening now around privacy, and with this software, I'm like, this is a big hurdle that I would have to personally get over if I was going to potentially invest. Now, maybe it wouldn't take me that long to get over it. It's also extremely powerful, but I don't know if it's just one of those things. You don't know how long, like each company, like with this privacy data, like you don't know how long it will be before there's crackdowns on it as well.
Well, I think that, like, I look at cars and I find it kind of interesting because one company will come out with a car and you go, oh, that is awesome. And then a year later, Ford comes out with the Bronco, and now Toyota's talking about bringing the FJ Cruiser back.
Of course.
And then you've got like Jeep, and this is in the off-road segment. Then you got Jeep that's just like steady. They're just always, 4Runners, just these steady. But now you see these Broncos, they're everywhere. They're everywhere. They've taken market share from somebody because all those people that would have bought those, the Jeeps, the FJ Cruisers and that, a lot of people have switched over to Bronco because they're new, they have a good style, and people. So there's these segments where you can go, oh, it's Ford. Yeah, but Ford has to compete against GM, and GM has to compete against Dodge, and then down the line, and Toyota and Honda, and on and on. So it's sort of like, again, you can almost get caught up in not realizing that these companies actually aren't as protected as you would think they are.
I think, and Rory, when you're talking about valuation, you're not talking about mergers and acquisitions. You're talking about investment.
Well, interestingly, I would look at it in a similar way. Like if we were going to go look at like a media company to acquire, I would be looking at. That's actually one reason when I went back into like look at like what I originally was putting up, like wrote out for like basically my screen for an investment company, is I would actually use very similar metrics, because if you're not operating the business, you want to have that baseline. So I want to see consistent revenue growth. I want to see consistent earnings growth. I want to see another one that I love. This was really helpful in 2020, is the current ratio. So the working capital. Can the company service all of its liabilities and have a little bit left over? So how much cash do they have versus their liabilities? That was really important. I've seen things where, Jerrod, you and I have talked to, we've looked at companies before, and you go, oh, this is interesting. They actually have a good base of cash until you see the next report, and all the cash has been drained. It's all gone. You're like, oh, this isn't very good anymore. This is not operating. Like, this is not operating to sell. This is operating to try and get a big chunk of cash with nothing backing it.
So, Rory, you're the financial guy, but I always remember a profit and loss statement is a summary of activity over a period of time.
Yes.
A balance sheet is a point in time report.
Mm-hmm.
And that's what you're getting at, is there's a bunch of cash there, but 5 days later, they've caught up on the receivables and it's not there. Now, all of that shows in the balance sheet, but it reflects differently.
Yes.
And when we look at, I've been involved in a number of acquisitions, and, without fail, the group selling is looking at the forecast, and the group buying is looking at the history.
Yep.
And I always look at payback period based on history.
Right.
So if you're buying a company for this much, how long is it going to take to service the debt if you're going to use debt to buy that company? Mm-hmm. And I had an interesting experience. I was in New York. I was invited to speak on innovation. And this conference was a CEO conference. And there were all kinds of different, it was very interesting groups. And the group on innovation, there were 3 of us that presented, and we chaired a meeting where there were about 40 people in the meeting. But the group on mergers and acquisitions, which I was not presenting on, and the presenters were facilitating that meeting. And we had done a few of them, And typically we would buy a company and we would structure part of the payout on the performance of forecast going forward. And we would engage the present owner for a period of time to help with the transition.
How long was that period of time? Did it range? Like, would it be like
1 to 2 years?
1 to 2 years? Okay, interesting.
Yeah. And one of the guys facilitating, and in his bio, he had done over 70 acquisitions. And
wow.
And he looked at me like I was retarded. he said, you never, ever keep the owner on one day past when you buy the company. He says, you never do that. And really? I thought it was interesting because we think about the transition and so on, but I've had both scenarios. I've had one that went very well. I've had one that was a nightmare.
Oh, okay.
And so his point is, it's done. You bought the company. Now,
and that is because is this now, maybe you can't say, but was this during your time with cementation, like for majority of the acquisitions that you worked on?
If
you can't mention it, that's
the majority of them. Yes. Yeah.
So
no,
that
we
is
did a few earlier, but
because sometimes, like, this is where it differs. For like, you are going to bring on that company to operate it under that brand, right?
Well, a couple of times we were bought as well. So,
right.
But I'm talking mainly about evaluating companies to purchase. Yeah. And we evaluated a lot of them. We bought a few.
Yeah. So like, actually, that's a good point to bring up too, because you've had experience on this. Ballpark number, do you think you looked at, like, say, like you ended up with buying a few? You probably looked at dozens over your time there, would you say?
Yeah, we looked at dozens, but we probably maybe looked at 6 or 7 seriously.
Okay.
Right? So you get the prospectus sheet and you look at it and you say, is it a fit? And maybe if it is, then you sign an NDA and you get into their data room. And then you look at it, and it could be circumstances. It could be, the market is tanked. We're not going to do anything right now. Mm-hmm. It depends. But we got quite serious, and we got to a point of signing on a few of them that didn't go through. And then there were a few that we did do. But yeah, you can't be a deal junkie either.
No.
Right? You've got to look at it and say, if it doesn't work, walk away.
Could you make that?
Once you get involved, you want to. There's that human nature. You want to close the deal. You want to buy it, but.
Yeah. When you were looking at the finances, did you typically look at 5 to 10 years, or was it a shorter term that you would look at? Like, I know you evaluated. Like, if I'm looking at a company to buy in the public market, I want to see a return on my investment in 5 years. I want to double it.
Yeah, we would look at the last 3 to 5 years.
Yeah. And
the future 3 years. And we didn't figure a forecast beyond 3 years made any sense. There's so many things that change.
No.
But yeah, and then we'd look at payback period based on earnings after tax.
Yeah.
And everyone's got different parameters. In our business, there's a lot of capital involved. So sometimes the assets on the balance sheet, you have to determine whether they're any use or not.
Yeah.
I mean, there can be some equipment there that's 10 years old that you'll never use on a job, but it should be written off by this time.
Or you'll see goodwill if they bought a company, you'll have like a big goodwill chunk that's never, like, it's useless because it's just from another acquisition as well. So there's things like that, or like old technology that's being valued way too high. You get all kinds of crazy stuff in like the goodwill and the asset. The balance sheet that's a very important part, because you're going, there's also like, are you evaluating it based on cash flow or balance sheet? There's also that. Yeah. So people will try and merge the two, which gets absurd, but you have to pick one or the other and figure out, okay, what's that return going to look like? Because some companies, they operate on, they really are cash generating businesses. They don't really have to put much into like the balance sheet in the way of assets. They don't have to do that. But that's interesting perspective though. But that's walking away. That's probably that's a really good thing to learn, because like the best investors, they know they have to basically leave a lot if they don't understand it fully, if there's like a red flag. But as you get involved and you start talking to people, you can get intertwined, and it can
That's the used car approach, right? The more time you spend on the lot looking at a vehicle, the more likely you are to buy that vehicle. And
right.
And car salesmen know that, and they'll engage you, and they'll want you to, it's time invested. Anyway, there's a whole psychology behind that. But it's hard to walk away once you've been involved for 3 or 4 months. Mm-hmm. You've spent, tens of thousands or even hundreds of $1,000s evaluating a company, mm-hmm. To actually say no.
Buffett must have, with his method, he's either just going to go buy shares, or he's going to say, if you want to sell your company, you're going to give me the number, and I'm going to say I'm interested, or he's going to say not interested. Like it's very smart, because he knows that psychology of the car lot, so he's not even allowing himself to go there.
No, but he's got the rep as well, and then the proven, and proven results. So
Well, and he's also not trying to. There is a thing with Buffett, is he's also not trying to get like management to exit, and that's not what he's doing, right?
No.
He just wants them to get a payout and keep working.
Yeah, he's just trying to buy the operating business and get the revenue from it.
Which is why it's so different. Like, it's so unique as well. Like that guy that was like, why would you keep somebody on? He's going, that's a completely different. Like, there's these people that buy, flip. Like they do all these, they buy and they piece stuff off. Like, there's some of these deal makers that they're kind of like trying to do the next one as quick as possible.
Well, that's a good point, because if your intention is to flip the business, then payback period doesn't mean anything.
Nope.
Right? All you're looking at is how long will it take to flip, and what's your return on investment going to be. So a completely different evaluation.
And are there assets that I can quickly even move into other companies, so it you basically build up this company that's going to be flippable to get your return. Like, it's a completely different animal.
Well, and there's a hybrid there. Sorry, Jerrod, I feel that we're not letting you into this conversation here.
I enjoy listening. I'm here. Please continue.
So the hybrid, and we bought a company years ago that had an office building. And it was a building that we weren't going to use in the long run.
They owned it, though? Like, they owned it.
So we bought the company. It was a great acquisition. After about 1.5 years, we sold that building.
Right.
So we weren't trying to flip the company, but there were some key assets that in the long run we didn't know we were going to use, and that we felt we could get a good dollar for them, and we did. So so that that it didn't cut the purchase in half, but probably 30% of what we paid for the company we recouped in a future sale of an asset.
Do you know what's interesting about that? Like, I've looked at, this would be more of something if I had a lot of capital to do this. If you go and look at, say, I'm trying to figure out. There's the exchange. There's the major exchanges in the USA, like the NASDAQ, the S&P, not the S&P, like the New York Stock Exchange. But then there is it's basically the penny stock exchange. But what is in there is, if you screen it out properly, you will find businesses. They're a cash business. They make profit. They have land, though. They have land and buildings fully depreciated. You can get some of these companies for way less than the buildings. And it's interesting that you said that, Roy, because you would look at some of these companies, and if they wanted to sell, like you said, you're getting a huge chunk back just off those buildings and land. And those deals are out there. It's just you need the capital to be able to do it. But it is interesting, because that's one thing where land and buildings they can make something very appealing. Jerrod, we've talked about it before, even in our business. At what point is there a point where instead of doing a lease, you actually have a studio, because long term it's going to get more valuable?
Yeah. Well, yeah, even a friend of mine, he's got he rented a space, so he actually rents it and he hosts parties. So he doesn't even host them. People have parties and they rent that space. Around the perimeter is all these offices. So people have rented out. So he's basically covering his base cost with the office rental. And then these people rent his space for their events. So he doesn't even have to organize or get anybody there. He just needs to have the infrastructure. And then he has a bar there as well, so he makes money off that. And I was like, that's so simple. And it's working great. Like they're booked up like crazy because in Vancouver, right? There's no space.
Nope.
Unless you want to go to a restaurant or a bar and stuff, but not everybody wants to do that. People want to go and like have these private parties, and it's a big space as well, right? In the downtown
So Jerrod, I didn't realize that. So he's got multiple offices that people can use. So that's consistent monthly. But then the weekend parties probably that can be almost your profit.
Yeah. So there's ways you can leverage off of like land, buildings, and that you just can't with. There's nothing really else that is comparable. Like you can't do that with anything else.
And Roy, banks probably love it too. Like if you're going to them for like partial like funding for an acquisition, I'm sure they look at those assets and go, yeah, this is great. Like we can write we can give you capital based on like those assets.
Oh, definitely. But they have to be liquid.
Yeah.
Right. So a scoop tram that's 7 years old. It's worth. Well, we know what it's worth.
Sorry, Savannah.
You just got to refurbish it.
Yeah. Before it's refurbished, we know what it's worth.
Yeah.
Oh boy.
But and again, this is not covering all the valuation model points, but that's like, I essentially from learning the investment, like looking at these companies, trying to find like the best ones in a sector that are the best at the best price, not the cheapest. That can go haywire really quickly. Lots of times there's a reason they're quick. Yeah. Like you said, Roy, is it a one asset business? That one asset gets shut down. Poof.
Yeah.
You are
higher risk. Yeah.
You're not liquid at all. Well, like at Tech Resources, they're across multiple minerals.
Yeah.
Well,
it gives you way more flexibility.
We won't even get into it today, but I think we should actually do it on another episode and we can all kind of look at this. But
okay.
Like that Terex.
I like that company.
They have Genie lifts. They have I had it up here. Let me give it a sec. I'll just give you some of their brands. Yeah, so Cedar Rapids, Franna, Kanika, Jaguars, Bidwell. Who else do they own? Simplicity, Power Screens. They have washing systems. A brand like that, like one falls, it's just a part. Because they've done something so, and I do want to like dig into them a little bit more on a different episode, but they've done something so interesting is they've diversified but without getting out of their field of competency.
Yeah, that's the trick.
It's like they have Genie lifts and they have screening plants, but they're kind of the same mechanisms. Like they're not that much different. The manufacturing facilities would not be drastically different, and they've just plugged in. They're in forestry, agriculture, a little bit, of course, construction, aggregate. They're just across all these sectors, but without these huge risks of didn't go into like a retail space or anything like that. They're just staying with what they do. Very interesting.
There was I guess it was in the 80s. There was a trend to diversification. Excuse me, and not what you're talking about, Jerrod, but to give you an example, the company I was with at that time was doing a lot of traveling, so they bought a travel agency.
Yeah,
and there's more to the story, Rory. It's not fun. What are you laughing about? This is serious.
No, it's just continue. I want to hear. This is fun.
and I was working. I was an hourly employee, and they set up a travel agency, and they brought up a manager, and she was on staff, And so now we've been married almost 40 years. It was a career move for me.
Brilliant.
But the travel agency part didn't last.
No.
It wasn't a fit for the company. They wanted to diversify, and they had this in their mind, but not just diversify. They wanted to be in different industries.
Yeah.
Right.
So, Jerrod, what you're talking about is the smart way to diversify is leverage your skills and leverage your network of clients. Yeah. Because someone that needs to buy a lift may also need to buy a cement mixer or whatever the
most of their products have there's some overlap somewhere in their.
Yeah. Jared, that's to shout out to Savin. That's like if I need to go buy a conveyor because I'm going mining, maybe I need a trommel too, and maybe I need a concentrator,
and then on and on and on. Yeah.
So that's where it's a diversified line of products, but you have those like core products that fit together.
I think you should also mention that it is a moat for a Terex as well because they control these market shares. There's other competitors, but they are deep enough now that they're always going to have. I mean, they've got cranes, everything, right? So they always have a chunk of the market share, and
And are they selling or are they renting or both?
They sell the machines
through distributors, right, Jerrod?
Distribution, yeah.
Yeah.
Unbelievable company.
Because that's another method of diversification. You're an equipment seller, but if you start leasing, and then there's lease to own, and there's different ways to diversify beyond just the product.
And they may do some of that stuff with through their dealership network. Yeah. I'm not sure. They're only their revenue last year was only I think just over $5 billion. So they're not. I think their market cap right now is about $3 billion. They're big, but they're not. They're not Caterpillar, right? Mm-hmm. So they've figured out how to create a moat in a actually quite limited space, really, by this diversification within their competency. It's very good strategy. Interestingly, they were also owned by GM at one point.
Okay.
Terex was?
Yeah, no, their history is very interesting.
Do you know what's interesting? Do you know, Roy, how you said about if you go into a company, you get that bias in a sense that you've been working on it for a number of years. I actually get this with investing because I look at this company and I immediately go, oh, pre-tax income, 10%. Oh, okay, there's one down year, 2020, throw it away, don't care. But I'm immediately looking at them and all of a sudden, if I start doing due diligence in this, I'm going to get closer and closer and closer. You have to, in a way, you have to identify, go to the bottom of the reports and identify red flags initially, because it can be, you could start throwing your money around really fast. You can go, okay, this is pretty cool. They made 10% last year. Obviously they're going to make that much again. You can start putting that bias into your mind, and you have to identify that. But what Jerrod said, you just said $3 billion market cap right now.
Yeah.
I haven't verified that yet, but if that is true, all of a sudden that multiple is getting really low on their earnings. In the last year. All of a sudden I'm going, I'm going to take a closer look. And I love those businesses, that heavy industrial. It's kind of like Wajax is a dealer for a whole bunch of these companies, also a public company. So there's always these companies that I'm looking at, okay, what would be a good one to take a shot at?
I just want to quickly add something too, is that even for myself, I'm trying to learn this in not the investment side, but in terms of people approaching us with projects. Because more and more, I had a gentleman, he was very nice guy, but he came in and he stopped by our studio and we, were chatting for a bit and he wanted to meet. And I quickly realized he's looking for an idea. He doesn't have an idea, right? And I just unfortunately don't have the time sort of to dig into a whole new idea. And that's a really clear example. But then I get other ones where I really like the people that I'm meeting with. I like what their concept is. I like what their organization is trying to do. And it almost becomes an investment. It's an investment of our time. Usually they're not asking for money from us. They may be even giving us money, but it's going to be minimized because we're going to try to get partners on for sponsorships. And so you're trying to kind of piece this thing together. And then I'm learning to go, okay, how much time? This is going to take me half a year to get this off the ground. But in that half a year, I am not dealing with building a plan for maybe Rory, one of your clients, or we're not working together on that because I'm focused on this. And that evaluation, it gets really tricky, especially when you're sort of an established company, because the more you're established, the more people will pull you in different directions. And I'm just starting to realize, like, okay, I'm getting pulled. I'm looking at 3 different projects right now. There's no way we're doing 3 more projects this year. Like, we're not launching 3 new shows. Like, that's not happening. And so I've got to cut something away, even if all 3 are good. At least one has to get cut. That's all. That's all I had to say on that. That's the end of my story.
Well, the time thing, you would see it in like these large corps. I'm sure the things that like take people away from like what's going to produce the best results. It's definitely an issue that happens.
Well, you get sucked in, right? That's what
Yeah.
that's what you were saying. You get sucked into these things, even if it's just a time suck of an idea, and you go, okay, realistically, what does this look like in 6 months from now?
Yeah.
Well, if in negotiating 101, before any negotiation, you establish the walking terms. What I mean by that is what's unacceptable, or what do you say sounds good, but we can't do it. And I've been in a few instances where I've looked at investments with friends, and not cranky old men drinking beer. I'd never invest with them, but with just people I know in the industry. And that's when these walking terms are really important. Because like you said, Jerrod, some people, they're friends, you get talking, it's all good. But then, when the rubber hits the road, you've got to take a hard look, and it's money that you've worked hard to earn. And you need to beforehand establish your own terms, like what kind of return do I need? What risks am I willing to take? Those things beforehand, and they should be consistent. Whether you're dealing with people you've known for 20 years or whether you're dealing with someone you've never met, the same walking terms should apply.
That's a good point, because you can, and that's actually probably a way, even for myself, I could streamline some of these conversations. Go, so this is our starting point. Like, this always has to happen. Everything else is a tack on, but this has to happen. In our case, a lot of times it's the cost of production, right? Because people see if you come up with, you got a loader on the back of a truck, everybody knows there's a cost to that. They just don't. No one's asking you to do them a favor with your loader, not, But in production, they see people holding up their phones and taking selfies, and they translate that to producing a show and doing a market reach with it. They're not the same thing. And so if you establish quite quickly what the parameters are of the production, now if someone can't work within that, okay, well, it's not that they're doing something wrong, it's just not the right fit, right? You can eliminate that quite quickly.
Yeah.
All right. Well, that's okay. Well, I got to make some phone calls.
Brutal. Apologies in advance.
Yeah, apologies in advance, everyone. Rory, how do you like the Rory? I'm sure you had some more to get to, but we'll have to circle back. Rory, how did you like this? Rory, how did you like this beer? Let's start with you.
It was good. It was a good beer for breakfast for sure. Roy, you picked some. Man, you're really like, I was eyeing up too. Like, you've got like this mocha beer too that we're going to be covering, but this was the Naughty Neighbor is it's good for like those naughty mornings when you want to get to it early.
I'm not sure what you're getting to early, Rory.
Should I be here for this?
Rory's a morning person.
Some morning glory. Is that what they call it?
No comment and completely unacceptable. Lenny's going to have to be brought back again.
Can we censor that, please?
Nope.
You got to realize that at my age, it's dinner or a movie. So these wild morning beer fests are a thing of the past.
It was okay. It was okay. I find like most pale ales, I drink them. I can drink them. If I'm playing hockey and that's what someone pulls out of the beer can, I can drink it. I didn't find it. Nothing really stood out to me. It just seemed like kind of. Honestly, it felt like a beer that I could just drink of. I could go to a liquor store and just kind of grab a regular brand.
Are you calling it bland?
Yeah, just there's nothing. If I'm drinking a beer that's sort of supposed to be different.
What was it we had last week? That one was punchy, I think. I think last week. I can't remember. What was
it,
last?
Yeah.
I thought we had the black lager last. Was that the last one?
I think so.
We did have a Fernie before that was
good.
that everyone really enjoyed.
Yeah, I feel like if I'm doing a micro brewery, I want to know that there's something a little not too over the top, but just something a little different. I just didn't find anything that sort of unique about this.
Yeah, this one's not punchy.
No, this one, like it's citrus, so it doesn't give. It doesn't have some of the tropical fruits that some of them do, which make them stand out a little more. It is a little bit hoppy, but it's kind of just got the two elements, citrus and hoppy, and that's it. And so it's refreshing, but it's not. It doesn't separate itself from the crowd, so to speak. I think that's what you're saying, Jerrod.
It's kind of beer.
It's one of those beers. Yeah. So.
Yeah. So what did you give it? What did you give it as a score, Roy?
For me, I think it's a 14. Like, I didn't give it a super suds. I like it. I think it's good, but it's not that unique. And that's one of the things we like in craft beers, right?
Yeah.
I mean, if we can drink Molson's and it's cheaper, but
this definitely
we're trying to try something different. So,
Jerrod, what would you give it out of 17?
Out of 17?
Rory's already devalued the.
He valued it because he can't be 20, so it has to be out of 17. Yeah,
we're talking too much on evaluation.
See, honestly, if I was just drinking if it was like, a Budweiser, then it's fine. But
yeah, it's got actually. Let me think.
It's supposed to be what it is. Then I'd say like a 12. Like I just. That's like buying a scotch. That's like for me, it would be like buying a scotch, and it has the same. It has nothing punchy. It tastes like an Irish whiskey. Like it's got to have something unique to that scotch.
But it has a fun label.
I do.
They probably sell a lot of it. They probably do sell a lot of it just because it's like where people just.
I think it's one of their core beers, and they've had it out for a while. I think it is popular, but
and shout out to Nickel Brook Brewing. They're not a sponsor, but they got on the show.
This is a good point, though. This is a good point. If I was going to Beer Belly, I'd probably grab a case of this because I know everybody's going to like it. It's going to be fine.
Yeah.
But if I was getting like some cigars and something like that, I would not buy this.
No.
Well, you can start a conversation with it. Yeah, I married an American, and 40 years ago we were naughty, but. Yeah, when it comes to actually how it tastes, that's when people are you going to buy a second case?
Yeah.
Right? That's the question. You might buy one, you might buy a 6-pack, but do you love it so much it becomes a fridge stocker? And this wouldn't be a fridge stocker for me.
No.
Yeah, you probably need a 15 plus for a fridge stocker, hey?
Well, 11 to 14 is honorable mention.
Okay.
15 plus what we call super suds.
Right.
Yeah. So we go below that, and it's, if you're struggling to finish one, it's going to get a lower rating. But I didn't struggle to finish this, but then the question is, would you buy another?
Yeah, I did a little bit. I wasn't, but it also might be because we're filming at 10 o'clock in the morning.
Yeah, that has no impact at all.
Well, gentlemen, thank you very much. Gowdy, thank you for producing this.
Thanks, everybody.
Anything to close with? Any thoughts? No?
No.
Okay.
I think we're good.
Well, we'll see you on the next episode, everyone. Rory, careful with those bread knives, butter knives.
Thank you.
And just don't touch the other knives.
First cut is the deepest, isn't it? That's a Vancouver guy, isn't it? Brian Adams.
There we go. There we
There
go.
you go.
That was Brian
There's
Adams.
a little cultural.
That wasn't Brian
Culture.
Adams, Roy. Was it? No, that was Sheryl Crow.
Didn't she date Kid
Oh
Rock?
no, okay, you're right. Cuts like a knife was Brian Adams.
It's like a knife. There you go.
My apologies. My apologies. They kind of all blend
And if
together.
we weren't on YouTube, we could do the outro, but
No.
we can't.
I probably heard it at the Tuesday night. Anyway, Sheryl Crow reference.
All right. Well, we'll be back with more butter knives and snow in the next episode. Thank you, everyone. We will see you on the next episode of The Crownsmen Show.